Welcome to our deep dive into the mystery of W.D. Gann's square of 9, focusing on the powerful technique of squaring price with price. This method, developed by the legendary trader W.D. Gann, has fascinated market analysts for decades. Today, we'll break down how this approach helps traders identify key support and resistance levels, all without considering the element of time. Whether you're new to Gann's methods or looking to refine your understanding, this video will guide you through the essential concepts and practical applications. Let's begin our journey into the world of price calculations and market pivots. Squaring price with price is a unique calculation method that involves adding or subtracting divisions of a circle to the square root of a base price, then squaring the result. This process generates support and resistance levels directly from the base price, completely independent of time. By focusing solely on price movement, traders can pinpoint where the market might pause or reverse. This technique is especially useful for those who want to simplify their analysis and concentrate on price action alone. Understanding this concept is the first step to mastering the square of 9. In applying the square of 9, it's crucial to start your calculations from major pivot points. These include all-time highs and lows, 10-year, 5-year, and 52-week extremes, as well as contract highs and lows for futures. By anchoring your analysis to these significant market turning points, you ensure that your support and resistance levels are meaningful. This approach helps filter out noise and focuses your attention on the most impactful price levels, increasing the reliability of your trading decisions. Thoroughness: each calculation should be done twice, once using the extreme high or low price that began and ended a swing, and once using the highest or lowest closing prices. This dual approach ensures you capture both the intraday extremes and the closing consensus of the market. While this may seem like extra work, it provides a more comprehensive view of potential support and resistance, helping you avoid missing key levels that could influence price action. Not all angles are created equal in the square of 9. Financial markets often respond most strongly to the 45-degree angle and multiples of 90 degrees, such as 180, 270, and 360. These angles represent key divisions of the circle and are associated with major support and resistance. For most stock-related tickers, it's recommended to use no lower than 180 degrees if plotting on a chart. However, if you're keeping calculations off-chart, you can use 90 or even 45 degrees for more granular analysis. While most markets focus on 90-degree multiples, bond traders sometimes find that 60-degree angles and their multiples, such as 120, 180, 240, 300, and 360, are just as important. This highlights the need to adapt your angle selection based on the specific market you're analyzing. Understanding which angles are most relevant can give you an edge, allowing you to tailor your calculations to the unique characteristics of each asset class. It's easy to get carried away with calculations, especially if you broaden your definition of major pivot points. However, too much data can obscure valuable information. The key is to be selective and judicious in your approach. Focus on the most significant levels and avoid cluttering your charts or spreadsheets with excessive numbers. This discipline ensures that your analysis remains clear and actionable, rather than overwhelming and confusing. Static angle calculations from major pivot points are especially useful when a market is approaching a suspected turning point. For example, if your daily chart is nearing a 360-degree price level, it's valuable to check if this level also aligns with a significant rotation down from an all-time high. This cross-verification can provide additional evidence that a major reversal is imminent, giving you more confidence in your trading decision. Recurring debate in square of 9 calculations is the 3-digit controversy. For consistency, many traders convert prices to 3 significant digits before performing calculations, especially when dealing with indexes above 1,000 or below 100. This standardization helps ensure that your support and resistance levels are comparable across different price ranges. It's also common to keep an off-chart table of natural, unconverted prices for reference, providing flexibility in your analysis. Effectiveness of squaring price with price can be backtested using historical data. Many stocks and indexes reached all-time highs in 1999 and 2000, followed by bear market lows in 2002. By applying this technique to those periods, traders can see how well the calculated levels align with actual market turning points. This hands-on approach builds confidence in the method and helps you understand its strengths and limitations in real-world scenarios. Let's look at a real-world example. In July 2002, AOL made a bear market low of 8.7, closing at 9.64. Using the square of 9, the 21st 180-degree cycle down from its all-time closing high of 94 adjusted to 3 digits calculated a key level at 9.33. While this wasn't the exact low or close, it was remarkably close, demonstrating the practical value of the technique. Such examples show that the square of 9 can highlight important price zones, even if it doesn't predict the exact number. Common question is how precise these calculations need to be. Gann himself didn't expect pinpoint accuracy. He accepted that near misses could be due to market lost motion or price lag. In practice, any bar containing the target price is considered a valid hit, and even a near miss by 1 or 2 bars is acceptable. For price and time applications, being within a few degrees is usually sufficient. This flexible approach keeps the method practical and usable. Let's break down the math behind the AOL example. First, the closing high of 94 was converted to 3 digits, becoming 940. The square root of 940 is approximately 30.66. The factor for 180 degrees is 1, so subtracting 21 cycles gives 30.66. 21 equals 9.66. Squaring this value and converting back from 3 digits gives us 9.33. This step-by-step process shows how the square of 9 translates price history into actionable levels. Square of 9 often reveals predictive qualities, but these are usually recognized after the fact. It's important to remember that no method is perfect, and the true value of this technique lies in its ability to highlight potential turning points rather than guarantee future outcomes. The key is to use it as a tool for awareness, not as a crystal ball. By combining it with other forms of analysis, you can improve your overall trading strategy. Summary: squaring price with price using the square of 9 is a powerful technique for identifying support and resistance levels. While it doesn't predict the future with absolute certainty, it provides valuable context for understanding market movements. By focusing on major pivots, choosing the right angles, and maintaining a flexible approach to accuracy, you can harness this method to enhance your trading decision. Remember, the goal is not to predict the future, but to recognize when significant price levels are in play.